Hi, everyone. Thanks for joining Jeff and I today. Um, I like your background. Looks like
Mm.
you're in your homeland.
Yep, that's Scotia Plaza behind me, and it looks like you are in Mexico.
I'm not in Mexico. I am in the GTA, but yes, my background's Mexico, which is significant today, but we'll get into that in a few minutes. So the Canadian banks have done very well in the last couple of years that I think investors are starting to wonder if it's time to take some profits and sell some of the shares. We are holding Scotiabank shares at the moment. So, what are your thoughts on the valuations right now, Jeff?
Yeah, so a lot of people are commenting on whether now is the time to take profits on the Canadian banks. Their valuations have not been this expensive in quite some time. We're of the view, though, that the Canadian banks have historically traded at a discount to the market, but we think that they deserve a market multiple. Decades ago, the banks here would lend a much larger percentage of their reserves than they do today. They would also write mortgages to not exactly credit-worthy borrowers, and they were not very diversified. So the discount made sense historically for those reasons. But today, regulations require them to do all sorts of stress tests on their borrowers. So
Mm,
it's harder to get a mortgage now than it was, 20 years ago. In addition, they have much more diversified businesses. They benefit from capital markets activity as well as wealth management. Those are major contributors to the Canadian bank profits. And they act counter to um, the mortgage business. So if interest rates drop, the Canadian banks will earn a lower spread on their mortgages, but that will benefit capital markets and wealth management. So they're more
mm.
diversified. And in addition, um,
Heavily regulated.
yeah,
The regulations from the Office of Superintendent of the Financial Superintendent
right.
has, yeah, it's stricter rules and regulations have tightened up over the last, well, many years. And bringing in, incorporating all three sectors, like you just mentioned, wealth management, capital markets, and mortgage lending, plus other lending, um, is tight.
Yeah. So for those reasons, we think that they should trade at a higher multiple because they're safer businesses and they're more diversified. So, you know, safe companies should trade at a higher multiple.
Hmm. All right. Interesting point. Let's talk a little bit about their dividend because that's an interesting story.
Yeah, Canadian banks are notorious for being dividend aristocrats. They raise their dividend every year. When we first started buying this for clients, we were getting a 5% yield. We're now getting under 4. But that leads us to talk about our favorite bank, which is Scotiabank. It has the best yield of the five. It's almost 4%, so it's just under that. Whereas the other Canadian banks, their yield all begins with the number 2. So you're certainly not buying these for income anymore. 5% is much better than 4, but when the stock price goes up, that's what happens. The yield goes down.
Mm,
Nevertheless, they do continue hiking their dividend. Scotia just raised theirs by 4 percentage points in the last quarter. Their last quarter was
that's
outstanding.
huge.
Yeah, their pre-tax, pre-provision earnings rose 16% year over year, and all their segments had very solid growth. So they were in a position to raise the dividend very recently.
Yeah. Yeah. And it's interesting too, because they have a bit of a unique story where they have international exposure down in Mexico, Chile, and Peru,
Hmm. Yeah,
right?
I mean, and then those are regions where a lot of people don't even have a bank account. So
Hmm.
if we continue to see some political disruption in Latin America, that would be good for Scotia because if it brings business investment to that geography, then the bank who has exposure there benefits, and that's Scotia. So right now, the bank trades at about 14 times earnings, which is much higher than it historically trades, but they're going to have double digit earnings growth this year, next year, and the year after that. So they'll grow into that multiple. If you look at what they're trading at, say 2 years out, it drops to about 11 times earnings, which is right in line with what they historically trade at. So we're going to hold on to this. I mean, they're growing. They're you know they're diversified. They're less risky than they were before. That's for sure. The whole group is. So we still
And the
like.
projection is solid and positive for the next few years forward.
Yeah, absolutely. And a lot of people were questioning the bank's decision to choose Scott Thompson, who came from outside the banking world. But I think he's doing quite a good job so far. So I
Yeah.
guess he's a breath of fresh air, isn't he?
Yeah. Yeah.
All right. So,
Okay. Thanks, Jeff.
okay, thanks, Eddie.